Hey, what's up, stock compounders? Brad here. So, Mohnish Pabrai released his latest interview, his latest talk to students of UCLA just a few days ago. And in this video, I want to share my highlights from that talk. You know, it's so exciting anytime Pabrai releases a lecture, a guest lecture, a Q&A like this. So, of course, I have a few, there's a few nuggets I picked up from this talk that I want to share here. So the first question he was asked was advice about starting a fund. Of course, Pabrai started his fund back in 1999. It was a partnership kind of modeled off of the original Warren Buffett partnership. And he shared something that I haven't heard before, which was, back when he was starting the fund, or I should say before he was starting the fund, he was kind of giving his friends stock tips because he started investing in 1995 and opened the fund in 1999. So there was 4 years there where he was investing, and he would kind of rattle off a stock tip to a friend occasionally. Now the issue with that is that he might not see that friend for a while, and so that friend wouldn't really know what to do with the stock. Should he keep holding it? When should he sell it? That kind of thing. And so it wasn't working all that well for these friends who were receiving stock tips. So they decided, all right, we got to sit Pabrai down and get him to start a fund. We want him to manage our money because it just doesn't make sense for us to do it. It's kind of piecemeal and it's just not working very well. And they weren't putting that much in to an idea that generated, say, a 3x return. It wasn't moving the needle on their net worth. So, of course, Pabrai starting to invest for his friends, that would make anyone a little bit nervous, I would imagine. And so Pabrai did something that surprised me. He guaranteed their principal, okay? He guaranteed what they put in to the fund. So if the fund dropped, if the investments didn't work out, Pabrai would give them their full investment back. Not only did he guarantee their principal, he guaranteed 6% per year, okay, which is incredible. It was only a $1 million fund at the time. Pabrai had a net worth of something around 10 million, so he figured, I can cover it. If things go south, it's worth protecting these friendships to cover that and guarantee these investors their money. So the problem was these friends, of course, this is a fantastic deal. Where else are you going to get guaranteed your principal? So they start telling all of their friends about this fund that Pabrai is running and this guarantee, right? So the fund is growing. There's more and more investors who want in. And of course, you can't scale that model. You can't, because once the fund gets larger than his net worth, even when it starts to get close to his net worth, he doesn't want to be on the hook if this thing goes south. So he goes back to his original investors and says, look, if we're going to scale this thing, if I'm going to grow this thing, we need to take the guarantee off the table. Okay, let's get rid of the guarantee. And of course, they're like, no, we like the guarantee. We don't want to get rid of the guarantee. Obviously, why would you just give up the guarantee for nothing? So Pabrai's like, okay, I'm going to shut down the fund. I'm going to return all of the money to the original investors, and I'm going to start a new fund where there's no guarantee, right? And of course, everyone who was with him originally in that guarantee fund moved over to the new fund. I found that a very amusing story. Right. So also he talks about, when you start a fund, it's really important to keep your fees down, especially if you have a structure like Pabrai had, not fees, expenses, where you have 0 fixed fees, and then a 6% hurdle, and then 25% on top of that is what Pabrai makes With a structure like that, you've got to run lean, especially at the beginning. So Pabrai was running the fund out of his house for the first year and a half. I think I remember he was eating at like Subway every meal. And that's an easy thing for people who go into business, particularly people who go into starting a fund. It's easy to think you need the fancy office, you need all the the fancy stuff in order to attract clients and look the part. But that's simply not the case, and that can get you into really big trouble if your expenses are high in the early years. It's just a lot harder to squeak through tough times. He was asked, how has his investment approach changed since he started his fund over the last 21 years? So it was interesting. He said the biggest learning he had was in the mid-1990s. That's when he was devouring everything he could find from Warren Buffett and Charlie Munger. Just a period of massive learning. He said 2020 is actually the second greatest period of learning for Pabrai as it relates to investing. And I found that very interesting. And his big epiphany in 2020 is to focus on great compounders at reasonable valuations. Now, Pabrai's approach, basically for the first 20 years of his fund, is buy a dollar for 50 cents. Okay? Find a company that's selling for half of what it's worth. Now, the issue with that is, all right, say it takes 2 or 3 years for the market to price it in line with its intrinsic value. Great, now you sell it and you've got to find another one, right? And you also have the taxes, right, that you've got to pay on your capital gains every couple of years. So you don't get, Li Lu talks about how, a big part of the magic of long-term compounding is holding companies and not having those tax hits, okay? He said you're basically getting a loan from an interest-free loan from the government when you hold, an investment for a long period of time. Obviously, it has to be a great business. It has to be actually compounding your money. So it can't just be any business, obviously. But the big epiphany, right? Focus on great compounders at a reasonable valuation. And here's something he learned from Charlie Munger. Do not sell it just because it gets to its intrinsic value, right? That's the whole game when you buy a dollar for 50 cents. You buy at 50 cents and you sell 90 cents, a dollar, somewhere close to intrinsic value. Now, what Charlie Munger, his philosophy is, even though there's no rational way to justify it, he's not willing to sell great businesses that he owns just because they appear fairly valued or even overvalued, okay? Look at Costco, for example. It's over 40 times earnings right now. Price to earnings ratio, over 40 times. He wouldn't buy it at that price. Charlie Munger wouldn't buy Costco at 40 times earnings, but he's not willing to sell it at 40 times earnings. And Pabrai went a step further. He thought, Munger probably wouldn't even be willing to sell it at 60 times earnings. If the price gets egregious, somewhere around 100 times earnings or more, he thinks Munger would probably consider selling it at that point. But this is a huge nugget that most value investors miss. Most value investors are looking to buy at a discount and sell at fair value. But the big lesson that Pabrai learned this year, or had kind of this epiphany about, is that's a difficult game. Okay, an easier game, still difficult, is to identify these great businesses that are fairly or even slightly at a bargain price, and let them grow your wealth for you. Okay, rather than hopping between all these 50-cent dollar bills. So Pabrai, he's always focused on discounted pies. He's only looking for growing pies now. Businesses where They're, gaining more and more market share, growing every year. So that's the big learning from Pabrai in 2020. And, based on that, well, I know he said Micron he sees as a long-term compounder, but he invested in one U.S. company this year. That was Seritage Growth Properties. So, it makes me think Pabrai sees Seritage not as a discounted pie, not as something that, is he bought at a discount to liquidation value, a discount to the real estate value, but that the business is actually going to grow and that they're going to be able to develop that real estate into something that's going to be worth more and more as time goes on. So, right, give it some room to run. Don't buy at 50 cents and sell at 90 cents. He talks about Maotai and Ferrari. So Maotai, like the largest liquor company in the world, I believe out of China, it costs $5 for them to make a bottle of their alcohol, and they're selling for $150 for a bottle, right? So that's a 30 times, revenue versus cost of goods sold. Very impressive. And Pabrai made like a 6 or 7x on Maotai in 4 or 5 years. And then he sold because he thought, okay, this thing is overvalued. But it wasn't egregiously overvalued. It was maybe high 20s price to earnings ratio. And of course, it went on to double in the next couple of years. Pabrai regrets selling Maotai. Same with Ferrari. He got off the train too soon with Ferrari. He didn't fully appreciate how great of a business Ferrari is, how incredible the brand of Ferrari is. Ferrari does not spend any money on advertising, okay? It's all word of mouth. Everybody wants a Ferrari. You don't have to try to find customers. The customers find them. So, yeah, that's it. And with the growing pies, the great thing about growing pies, like I said before, he doesn't need that many, right? 1 or 2 a year is plenty. So that's his focus now, finding 1 or 2 long-term compounders, great businesses that are going to grow their piece of the pie over the next decade or more. He was asked about his investments overseas, his foreign investments in Turkey, in South Korea, in India. Pabrai would prefer to buy all of to invest in the U.S. The reason he's investing outside of the U.S. is because he can't find value in the U.S., okay? And, he needs to make investments. If he's just sitting in cash, he's losing money due to inflation. So, he'd prefer to invest in the U.S. It's a tough market. It's been tough. I mean, he's only made 3 investments in the U.S. In the last 4 or so years. And where does he find ideas? He likes to look at Value Investors Club, which is something that I've been trying to look at every day. What are the new write-ups coming out on Value Investors Club? It's usually a very quick pass. I look, if it's not in an industry that I'm interested in or understand, I just move on to the next one. And there's usually only maybe 3 or 4 new write-ups each day on Value Investors Club. He also mentioned SumZero, which is a membership site. I don't have a membership to SumZero. I don't know all that much about it. One thing I wanted to mention from the beginning, he was asked about advice for launching a fund. Now, I actually wrote him a letter or a card. I sent him a card asking for kind of advice on the structure of the fund, of the partnership, where to find, the details about how to set that up. Because, Pabrai had some issues setting up his partnership initially. He hired a lawyer that wasn't a securities lawyer, and he had to redo it, and it was kind of a pain. And his advice to me was, ask the people at corner of Berkshire and Fairfax, which is a message board that I've talked about multiple times on this channel. But it's interesting. I haven't heard him talk much about corner of Berkshire and Fairfax anymore. I think he's got a little beef with corner of Berkshire and Fairfax. And I won't really go into that, but I think there's some stuff there, some juicy stuff happening. And then lastly, someone asked him about his inner map, right? Pabrai has talked about this before where, 20 some years ago, he did this very intensive work with some industrial psychologists, 2 industrial psychologists. And he they offered to write his instruction manual for him, who he is at the core, who he is as a human. And it was pretty funny. I enjoyed this part. So one of the 2 industrial psychologists that really cracked Pabrai's brain open, they got this really deep glimpse into who he is. When Pabrai said, I'm starting a fund, an investment fund, one of the industrial psychologists said, I need to invest with you. Here's $100,000. Now, I don't know what percentage of that psychologist's net worth that was, but it was amusing to me how, this psychologist saw that it was a perfect fit for Pabrai, for him based on who he is internally, for him to be managing an investment fund, to just, without even knowing him, he just met him through this work, creating his inner map, to give him $100,000. And of course, that psychologist is quite pleased with the results of that. He is also a guy who really believes in his product. He really believes that, this thing that they're creating, this map that they're creating for people is, dependable, reliable. So yeah, that's it, guys. Those are my highlights from this latest interview / Q&A with UCLA. Let me know what your highlights are. I'm curious what jumped out at you from this 1-hour interview with Pabrai that just came out a couple of days ago. And I will link to that in the description. But I'm really curious to hear from you. What are your highlights? Let me know. Let's continue the conversation in the comments. All right, guys, that's all I got for today. I will see you in the next video. Take care.